Good morning and welcome to the Killik & Co market update. There's been some excitement around the market and around media channels regarding which company might get to the valuation of $1 trillion first. I think realistically it was widely expected it was a two-horse race between Apple and Amazon, and I think there's probably some wagers swapped across trading desks around the city in terms of who was going to get there first. Both Amazon and Apple have reported results since last week's market update. And in case you hadn't read about it already this morning, Apple took the $1 trillion plaudits last night, or just after the open yesterday afternoon, and became the first company in history to be worth $1 trillion. Looking in brief at the results, we can see here Apple increased revenue by 17%, beating expectations of a 15% rise, and earnings per share increased by 40% to $2.34, beating consensus of $2.18. And Amazon group revenue rose 39%, which slightly missed consensus estimates of 40%, but earnings per share were well up 121% to $5.07, which significantly beats the consensus of $2.53. Away from the novelties of $1 trillion market caps, one of the biggest news items in tech this week has been Facebook and its record-breaking $120 billion market value fall post-earnings. The company actually reported fairly good results, but investors reacted negatively to warnings regarding a likely slower growth rate going forward and sent shares tumbling around 20% lower. So this combined with some reasonable post-earnings pullbacks in the likes of Netflix and Twitter. We've seen some of the parts of the tech sector struggle a little bit this week as investors look to recycle capital into other sectors to take a bit of heat out of their portfolios. Earnings season more generally in the US has been fairly strong. So we've had 80% of all constituents in the S&P 500 report earnings so far, and so far of those 85% have surprised the upside on earnings, and 72% of those have surprised the upside on sales and revenues. The Bank of England raised interest rates yesterday from 0.25% to 0.75%, which is as the market expected. It takes interest rates to the highest level they've been since 2009. What was somewhat surprising is the decision was unanimous. We had all 9 voting members of the MPC vote in favour of a rate hike. The market was expecting it to be 8-1. So this initially sent sterling higher against the dollar, which helped it recover some of the day's losses, but it gave it all back during the post-announcement press conference. Governor Mark Carney said that the UK needs modest tightening and that interest rate increases will be limited and gradual. And he also said that the Bank of England is looking at the ability of households to shoulder rate rises at present and going forward. The catalyst for the reversal in sterling's move higher was the market reining in its expectations of further interest rate hikes in the future. It also has a lot to do with the Bank of England continued concern and caution surrounding Brexit and the impact that it may or may not have on monetary policy, i.e. setting interest rates and quantitative easing to ease credit conditions. For now, the market's looking to September 2019 for the next rate hike, and sterling remains under pressure from a stronger dollar, political and Brexit-related risks. The rhetoric surrounding trade wars continues to rumble on this week, and to that point, President Trump is supposedly looking at potentially increasing rates or tariffs even further from 10% to 25% on $200 billion of Chinese imports. As of now, the Chinese have called it blackmail, and the US have said, look, so far nothing's been decided. Investors remain wary of the potential for a trade war, and as a result, the Chinese currency, the renminbi, traded at one-year lows overnight, and Asian indices have also been struggling to gain positive traction, as have some commodities such as steel and copper. And we can see some of the effects that this rhetoric is having if we compare the performance of the S&P 500 with that of the MSCI Asia, excluding Japan. So this chart shows the year-to-date performance of both benchmarks, and we can see that there's been a marked underperformance in Asia since the trade tariffs found their way into the headlines. Looking ahead to next week's calendar, it's again pretty busy, but we'll be keeping an eye out for the likes of Walt Disney, Prudential, Glencore and HSBC, just to name a few. That's all from us. We'll be back next week. Have a great weekend.